If you've been doing Roth conversions or if you've been thinking about starting them, there is a conversation happening right now in the retirement community that you absolutely need to hear because a new tax law was just signed. And some people are saying Roth conversions are now dead, completely pointless, a waste of time, something you should stop doing immediately. And other people are saying the opposite, that Roth conversions are more valuable than ever, and if you stop now, you'll regret it for the rest of your retirement. So who's right? And more importantly, what should you actually do with your own money in 2026? That's exactly what I'm going to answer today, and I promise by the end of this video, you will have a clear, honest, no-nonsense answer. Not a vague, it depends. That leaves you more confused than when you started. But first, let me make sure everyone watching understands what a Roth conversion actually is, because this topic gets complicated fast and I want everyone on the same page. A Roth conversion is when you take money sitting in a traditional IRA or a traditional 401k, money that has never been taxed, and you move it into a Roth IRA. When you do that conversion, you pay income tax on the amount you move in the year you move it, just like a paycheck. That money gets added to your taxable income for that year. But once it's in the Roth, it grows completely tax-free. You can withdraw it tax-free in retirement. And this is huge. It is never subject to required minimum distributions. So the trade-off is simple. You pay a tax bill today, and in exchange, you eliminate a much larger tax bill in the future. The reason millions of retirees have been rushing to do Roth conversions over the past several years is specifically because of the tax rate environment. Back in 2017, the Tax Cuts and Jobs Act lowered tax rates across the board, but those lower rates were set to expire after 2025, after which rates were scheduled to jump back up significantly. So the retirement planning community said, do your Roth conversions now while rates are low, because once they go up, conversions become much more expensive. That was smart advice. Convert at 12% now instead of 22% later. That's a massive difference. But then the One Big Beautiful Bill Act was signed on July 4th, 2025, and it changed the equation in a very significant way. The new law made those lower tax rates permanent. They are no longer expiring after 2025, they are locked in going forward. And that is why some people are now saying Roth conversions are dead, because the primary reason to rush into them was the looming tax rate increase, and that increase is now off the table. So let's answer the big question directly. Are Roth conversions dead? The answer is absolutely not. But the reason you do them, and the way you do them needs to change. The argument for Roth conversions was never only about the expiring tax cuts. That was one reason, and it was a compelling one, but it was never the only reason. There are at least 5 powerful reasons to still do Roth conversions in 2026, and some of them are actually stronger now than they were before the new law. Let me walk you through all 5, because understanding these is the difference between making a great financial decision and making a very expensive mistake. Reason number 1. Required minimum distributions are still coming for your traditional IRA, and they don't care about your tax situation. When you turn 73, the IRS is going to force you to withdraw money from your traditional accounts, whether you want to or not, and every dollar that comes out is taxed as ordinary income. If you've done nothing to reduce your traditional IRA balance before then, those forced withdrawals can be enormous, easily $40,000, $50,000, $60,000 a year or more. That kind of forced income can push you into a higher tax bracket, cause more of your Social Security benefits to become taxable, and trigger Medicare premium surcharges called IRMAA. Every dollar you convert to Roth now is one less dollar that will be forced out of your traditional account later. You are choosing when and how to pay the tax instead of letting the IRS choose for you. That benefit has nothing to do with whether tax rates go up or down. It's about control, and control over your own tax situation is always valuable. Reason number 2. Tax rates being permanent today doesn't mean they stay that way forever. Yes, the One Big Beautiful Bill Act made current rates permanent, but permanent in tax law just means there's no built-in expiration date. It doesn't mean Congress can't change them again. We are sitting on the largest national debt in American history, and at some point, somebody is going to have to pay for it. Whether that's in 5 years or 15 years, the mathematical reality is that tax rates will likely need to go up at some point in the future to address the debt. And if your money is in a Roth when that happens, you are completely protected. Converting now at today's rates is still buying insurance against future rate increases, and that insurance is valuable even if the threat isn't as immediate as it was a year ago. Reason number 3, and this is the one that most people aren't talking about yet. The new $6,000 senior deduction creates a conversion opportunity that simply didn't exist before. Remember the new deduction we discussed in a previous video? Up to $6,000 extra for individuals 65 and older, or $12,000 for qualifying married couples, available through 2028. Here's how it connects to Roth conversions. That new deduction shields up to $6,000 or $12,000 of your income from federal tax, which means if you do a Roth conversion of up to that same amount, the new deduction can effectively offset the tax cost of the conversion. Let me show you this with real numbers, because the math is genuinely exciting. Let's say you're a single filer, age 68, and your total income this year is $40,000 from Social Security and a small pension. With your standard deduction of $16,550 and the new $6,000 senior deduction, your total deductions come to $22,550. That means your taxable income is only $17,450, which sits comfortably in the 10% tax bracket. Now here's the opportunity. The top of the 12% bracket for a single filer in 2026 is approximately $47,150 of taxable income. You have nearly $30,000 of space between where your taxable income sits now and where the 12% bracket ends. You could do a Roth conversion of up to $30,000, pay tax on it at 10 or 12%, and completely avoid the 22% bracket. That's $30,000 moved into your Roth, growing tax-free forever, at a tax cost of somewhere between $3,000 and $3,600. And because of the new senior deduction expanding your overall shield, you can potentially convert slightly more than you could have before without hitting the next bracket. This combination, low brackets, new senior deduction, and Roth conversion, is one of the best tax planning opportunities retirees have seen in years. Reason number 4. Your heirs will thank you. When you leave a traditional IRA to your children or other beneficiaries, they have to pay income tax on every dollar they withdraw, at their tax rate, not yours. And under the current rules, most non-spouse beneficiaries have to fully empty an inherited IRA within 10 years of receiving it. If your children are in their 50s and still working when they inherit your traditional IRA, those forced withdrawals could push them into the 22, 24, or even 32% tax bracket. But if they inherit a Roth IRA instead, those withdrawals are completely tax-free. Every dollar comes out without touching their tax bill. By converting now, you are paying a lower tax rate today so that your children don't have to pay a higher tax rate later. It's one of the most generous financial gifts you can give your family. Reason number 5. The flexibility and security that comes with having tax-free money available. When all of your retirement money is in traditional accounts, every single dollar you need in retirement creates a taxable event. You can't spend anything without triggering taxes. But when you have a mix of traditional and Roth money, you have choices. In high-income years, you pull from your Roth and pay nothing. In low-income years, you pull from your traditional and pay very little. That flexibility is worth real money every single year of your retirement, and no tax law change takes that away. A large, unexpected medical expense, a home repair, a helping hand for a family member. Being able to handle those from your Roth without creating a taxable event is a kind of financial freedom that most people don't appreciate until they need it. Now that we've established why Roth conversions still make sense, let's talk about how to do them correctly in 2026, because doing them wrong can cost you just as much as not doing them at all. The most important rule of Roth conversions is this: never convert more than you can handle in a single tax year without pushing yourself into a higher bracket or triggering unintended consequences. The goal is to do partial conversions every year, filling up space in the lower tax brackets methodically over time, not dumping everything into a Roth in one year and creating a massive tax bill. Here's the framework I use. Start with your expected income for the year from all sources: Social Security, pension, part-time work, investment income, required minimum distributions. Then subtract your total deductions, your standard deduction, the new senior deduction if you qualify, any other deductions available to you. The number you're left with is your current taxable income, and the space between that number and the top of your current tax bracket is your conversion sweet spot. That's the amount you can convert this year while staying in the same bracket. No bracket creep, no jumping to a higher rate, just clean, efficient conversion. Now here are 3 critical traps you must avoid when doing Roth conversions. Trap number 1. Converting so much that you cause more of your Social Security benefits to become taxable. Remember, your Social Security taxation is based on your provisional income, and a Roth conversion adds to that number. If your conversion pushes your provisional income above the threshold, you could suddenly find that 50 or even 85% of your Social Security is taxable, which can wipe out the benefit of the conversion entirely. Always calculate the impact on your provisional income before you decide how much to convert. Trap number 2. Triggering IRMAA surcharges on your Medicare premiums. Medicare Part B and Part D premiums are based on your income from 2 years ago, so a large Roth conversion in 2026 affects your Medicare premiums in 2028. The IRMAA surcharges kick in at $97,000 for individuals and $194,000 for married couples, and they can add hundreds of dollars per month to your Medicare costs. A conversion that looks cheap at 12% can suddenly become much more expensive when you factor in the Medicare surcharge it triggers 2 years down the road. Trap number 3. Using your Roth account money to pay the tax bill from the conversion. When you do a Roth conversion, the tax bill needs to come from outside money, from your savings account, your checking account, anywhere except the Roth itself. If you use Roth money to pay the taxes, you're effectively shrinking the amount that gets to grow tax-free, and you may also owe an early withdrawal penalty if you're under 59.5. Always pay conversion taxes from non-retirement funds. That way, 100% of your converted amount stays in the Roth and compounds tax-free. Now, let me address one concern I hear a lot. People say, "Bob, I'm already in my 70s. Isn't it too late for Roth conversions to help me?" And the answer might surprise you. No, it's not too late, but the math changes. For someone in their late 60s or early 70s, conversions are still powerful for the legacy benefit, reducing the tax burden on your heirs. They're also valuable for RMD management. Converting now reduces your future required minimum distributions, which simplifies your tax situation in your late 70s and 80s. The break-even point on conversions shifts as you age, so the strategy becomes less about your own long-term savings and more about estate planning and RMD control. Even converting $50,000 to $100,000 over 2 or 3 years in your early 70s can meaningfully reduce your lifetime tax burden and leave your family in a much better position. Now let me also address the flip side. Who should not do Roth conversions right now? If your income is very low and you're already in the 10% bracket with little or no room to convert before hitting the next bracket, conversions may not make sense until your situation changes. If you expect your income to drop significantly in the next year or two, maybe a pension starting, a property selling, it might be worth waiting for that lower income year to do your conversion at an even lower rate. If converting would push you onto Medicaid, because Medicaid eligibility is income-based, this needs very careful evaluation with a professional before you do anything. And if you genuinely need every dollar in your traditional IRA to cover current living expenses, don't convert. Your cash flow today is more important than tax optimization tomorrow. The bottom line on Roth conversions in 2026 is this. They are not dead, they are not the same as before, and they require more thought and precision than ever. The urgency of the expiring tax cuts is gone, which means the panic conversion approach is wrong. But a thoughtful, systematic, bracket-aware conversion strategy is still one of the most powerful tools available to retirees. The new senior deduction creates a genuinely new opportunity to convert more efficiently than ever before. Don't leave that window open without taking a careful look. And the long-term benefits: RMD control, tax-free legacy, income flexibility, protection against future rate hikes. Those are all still sitting on the table waiting for you. Here's your action plan. Calculate your taxable income for 2026, identify your bracket space, factor in the new senior deduction, check your provisional income impact, check your IRMAA thresholds, and convert only what makes clean mathematical sense. If this feels overwhelming, that's okay. Even a small conversion done correctly is better than doing nothing or doing too much incorrectly. Start with 1 year, see how the numbers work, and build from there. You don't have to do this perfectly to benefit from it. If this video helped you think about Roth conversions more clearly, hit subscribe, because every week I break down retirement money topics just like this in plain, simple English. No jargon, no panic, just real information you can use. Share this video with someone who's been doing Roth conversions and might be wondering whether to stop. This is exactly the conversation they need to have. I'm Bob, this is Retired Not Broke, and I'll see you in the next one. And drop a comment below. Are you currently doing Roth conversions? Are you thinking about stopping? Or are you just starting to learn about them? I read every single comment, and I want to know where you are.